Fye Finance family, welcome to this edition of Let's Talk Tuesday. So, I'm super excited because this is part 2 of tax strategies. Last week, we gave some tax strategies to our individual taxpayers. This week, we are focusing on our business owners, our small business owners, right? Specifically. So I'm excited because this is where I get to have fun with my clients in the tax planning process, in the tax strategizing process. This is where me and my clients get to have a lot of fun. So hopefully you rock with me throughout the entire live. I'm going to give a lot of information. So get your pens, get your paper ready, take down some notes. And then we'll definitely have an opportunity to share with you how to connect with me after the live. Should you want to book a tax planning strategy so that we can go over your current situation and see what tax strategies we can put in place for you. Okay, so last week, like I said, we kicked it off with individual tax strategies. This week, all about the businesses, right? So the first thing that I tell my small business owners to do is leverage your assets. Let me tell you why this is important, okay? Most of the items that you're going to buy for your business, you're going to need anyway in order to generate some type of income. So why not only have that to generate income, but use it also as a tax strategy. So if you have assets, think about your assets like equipment, maybe vehicles, right, for your business. People are assets, okay? Don't forget about that. And so you want to leverage the current assets that you have for your business and use them to get for tax strategies. So here's one way, okay? Everybody knows when the pandemic hit, there was this thing called PPP loans, right? And so if you were fortunate enough to take advantage of a PPP loan in order to help lighten the blow that you may have suffered due to COVID-19, now is the time that those are getting into the forgiving phase. Okay, so now those lenders are reaching out to you and they're saying, hey, we need certain documentation in order for you to have this loan forgiven. So then the loan converts into a grant, essentially. Okay, so leverage the your assets of your employees, right, that you had to use in order to get that loan forgiven. So make sure that you are working with a financial professional so that you can provide the proper documentation to get those loans forgiven. Okay. So another way for you to leverage your employees is with the employee retention credit. So this was something that was rolled out again as a part of COVID-19. So they actually give you a credit for retaining your employees during the time where businesses were affected by the pandemic. Okay. So if you were affected by the pandemic, meaning that you lost revenues, I believe it's in excess of 20 to 30%, but you still maintain your employees, then you may be eligible for this particular credit, right? So make sure that you take advantage of that, leverage those assets. Hey, Monique, and throughout the live, if you have comments, questions, please feel free to drop them in the chat, right? And I'll definitely make sure I pause to address those. Hey, Charles, new channel art is fire. Thank you, Charles. So next, moving on to the next asset, right? We talked about having cars or having buildings or having equipment for your own company. So you can leverage those assets too. All right. So, hey, JP. So a way of doing that is by it's called the bonus credit. Okay. So this bonus rule was rolled out, I want to say it was in 2018. And so how it works is usually when you purchase an asset for your business, then you have to depreciate that asset over the life of the asset. Okay, so on average, a car is about 10 years, right? So you buy a $50,000 car and it has a life expectancy of 10 years. So you're depreciating the asset over the life of the car, over those 10 years. Now, the bonus rule says, you don't have to wait those 10 years to depreciate that asset. It will allow you to depreciate the asset up to 100% in some cases, for vehicles up to $18,000 in the first year. So the year you purchase that vehicle for your business, now you can expense depreciate up to $18,000. See, you see how you leverage that asset? So not only do you have this asset that you're using to help you generate money in some way, shape, or form, but now you're using it as a tax strategy, right? You're leveraging that asset. So we talked about people, we talked about cars. Do that same thing for you can do that same thing for equipment that you use. All right, and your equipment, you may be able to do it 100%, but cars, I know they limit you at 18,000 for the first year. All right, so leverage those assets. All right, and then the next thing we want to do is we definitely want to reduce our taxable income, right? And how do we do that? We do that with deductions. Okay, so there are a lot of deductions out there for small business owners. I'm only going to touch on a few because y'all, I only got so much time. Okay. But again, definitely connect with your girl after the live and we could definitely do a deep dive. Okay. All right. So the first thing that I love to share with people, because it's so easy to do, it's so easy to set up. It's just like my favorite. So the first thing I say is start your retirement savings plan. Okay. So it is helping you reduce your taxable income dollar for dollar. So that's the difference between a credit and a deduction. So a deduction is reducing your taxable income dollar for dollar. A credit is reducing your taxable liability once the tax is assessed. So we're going to get into that, right? We're going to talk about credits too. So deductions, right, that you can take right now in order to reduce your taxable income dollar for dollar is contributing to a 401k solo, so that's for a self-employed person, or contributing to a SEP IRA. Now, I would say I like the solo better because of the benefits that I'm about to explain to you that you can get. So you definitely want to make sure that you're writing this down. And as soon as you finish with this live, I would say definitely go to like fidelity.com because they have great individual retirement accounts for small business owners. And you check it out because you're going to have to work with a financial expert to set this up right. Okay. So a SEP IRA, we'll start with this one first. The SEP IRA is a retirement account that only allows employers to contribute on behalf of the employee. Now, a regular IRA, right, does the same thing where you say, okay, if money is taken out of your check, the employer makes a contribution to the account on your behalf. Even some employers match you dollar for dollar up to a certain percentage. Great, right? But you're limited to, I believe it's like $6,000 or $6,500. Okay. With the SEP IRA, your limits are increased. So you are limited for 2021 tax year. You are limited to 25% of your income or your compensation, or $58,000. Okay. So you can see how much of a benefit that is versus your regular employer plan of $6,000 versus the $58,000. Okay. So let's say you earn a salary of $100,000. That's how much your company is paying you. So 25% of that is $25,000 that you can now contribute to a retirement plan. Okay. So now you can put more duckies away for you to save so that when you do retire, you can still live the life that you're accustomed to living, right? Because now that money is just growing for you. Okay. So that's the difference between contributing to, a SEP IRA versus a regular IRA, is that limitation, right? It increases for you. So I tell people, take advantage of it if you're a small business owner, okay? So if you think that's dope, listen to this one. So the 401k plan for small business owners, there are some drawbacks. So here's the thing. It allows you to contribute more. However, right? You can only utilize this if you are a one-man show. All right. So if it's just you and only you working your business, then you can use this plan. If you are just like a contractor, independent contractor, just, a sole proprietor working for yourself, you can use this plan. Okay. If you have employees other than yourself, you cannot use this plan. Okay. Unfortunately. Now, let's get to the good part. With this plan, your employer can contribute on your behalf up to $19,000. I want to make sure I get that right. No, I'm sorry, 25%. So 25%, your employer can contribute on your behalf. Same as the SEP IRA, right? 25%, 25%. So we said if you're making $100,000, that's $25,000, right? Now, this plan also allows you as the individual to contribute up to $19,500. So $19,500 you can contribute in addition to your employer contributing on your behalf. See how that works? Now, you are the business, right? Like, you're the employer, you're the employee. So it is you contributing, but it allows you to contribute more. Oh my gosh. So now we're at $44,000 that you can contribute to an account if you are being compensated $100,000 a year. Do you see what I'm saying? Like, I get so excited when I talk about this because I'm like, oh my gosh, it's a no-brainer. And so with that being said, again, the max contribution is $58,000, same as the SCP. But this way allows you to definitely push more into that retirement planning, right? Push more into that. And I know a lot of us are like, well, I don't want to push that much. You don't have to. But the good news is you're able to, right? Like, if you ever had to, you're able to do it. So definitely take advantage of that deduction because that's a huge one. Another thing that people forget about are just writing off all of your expenses, right? Make sure that you are using an accounting platform to keep track of your revenues and your expenses. You want to make sure you write off every single expense that is being utilized for the business, okay? One thing to note that was a biggie last year, and now it's becoming a big deal this year as well. Entertainment used to go hand in hand with meals, right? I know if for my small business owners, you look at a profit and loss statement, you see meals and entertainment, okay? I started telling my clients last year, because I knew this was happening, to let's start separating them. Let's put meals on one line, let's put entertainment on another line. For a long time, small business owners were able to schmooze clients, right? You get tickets to events. Oh, we're going to write it off. We in the skybox. We're going to write it off. Now, the government is saying, no, we're not paying for any entertainment costs. You cannot write off any entertainment costs. Last year it was 50%. Okay, they were giving y'all, they were trying to show y'all, okay, we're about to do away with it. Last year it was 50%. Now it's like none of it. So you definitely want to make sure that you are separating meals and entertainment. You're separating the two. So if it's an entertainment bill, just know I can't write that off. But if it's a meals bill, you can write that off. And it's only up to 50% for your meals. Okay. So I wanted to make sure I was clear on that because that's a big change for a lot of people. I have clients, that you have to schmooze sometimes to get a client or to close a big deal. But I just wanted to make sure that I made you aware of that change so that you can take advantage of that deduction. I don't want you to lose your meals deduction because you got it in there with the entertainment, right? So let's separate those two. Another thing that you can do, track your mileage on your car. All right. So I personally don't use my car as much as some other owners may be using their car. But if you are going to use your car, track your mileage, save your receipts. There are often, most times when I'm preparing a tax return for a client, the mileage gets them actually more of a deduction than the actual cost, right? So when I say actual cost, I'm talking about insurance. If you own the car, you can write off the interest. Did y'all know that? Right. I'm telling y'all, I'm on a whole nother level when it comes to this tax strategy thing. So the interest you can write off. If you're leasing a car, you can write off the entire lease payment, right? As long as it's business related, okay? If you have insurance, I said repairs, fuel expense. So most of the time, depending on how heavily you use the car, all of those expenses may not be as beneficial as taking the mileage rate. All right. So definitely track your mileage. Also track your expenses, but definitely track your mileage. So we got a question. I'm going to pause for calls. Casey, hello, Casey. He says, he asked, is there an application that you could use to help track your miles? Yes, I'm so glad you asked. I personally use Quickbooks. Most small business owners use that as an accounting platform, and it actually has a mileage tracker built into it. So literally, when I jump in my car and I know I'm traveling for business, I can just hit boop, start, and it just starts tracking my mileage for me. And then when I'm stopped traveling, or when I'm done with my travel, and I just stop it, and it records it for me and it logs it for me, and I have it there for the end of the year. So there are other applications out there, I'm sure, as well. I just think that that's the easiest because it's like an all-in-one platform. So all of that information is readily available when your accountant is ready to do close your books and prepare your tax return at the end of the year. So great question, Casey. Thank you so much for asking. All right, another thing that small business owners forget to utilize, this is the easy one, your office space within your home. Okay. I know some of you probably overlooked this. It's not a lot of space. Let me tell you something. I utilize every single deduction that I can. Okay. And so office space is definitely one of them. So just how you do it is you just measure the square foot that you're using, the square feet that you're using. And you should know the square footage of your home, or if you don't, look it up. And then what they're going to do is allow you to take a percentage of all the expenses that it costs for you to like manage your home, right? With your mortgage, you can't write off the mortgage, but maybe you can write off the interest. Okay, you have insurance, right? And you can put that in there. Your utility costs, you can put that in there. Any repairs or upgrades you have to make to accommodate your office space, you can put that in there. So you want to make sure that you are putting all the expenses that it takes to run that home, right, for you, and then making sure that you're putting in the proper square footage information so that it can allocate a portion of the expenses to your business, right? So another one people overlook, but I'm telling y'all, easy peasy lemon squeezy, right off that office space, okay? And so then that leads me to the next thing, right? You want to make sure that you are setting yourself up for success, right? And so how do we do that? We talked about reducing that taxable income. We talked about leveraging your assets, right? So let's continue that process, and let's take advantage of some of these credits out there, okay? Setting yourself up for success is connecting with a professional who is going to ensure that you take advantage of everything that I just said, okay, including what I'm about to tell you, because there are not only a lot of deductions out there for small business owners, but there are a lot of credits. And so remember, I say your deductions reduce your taxable income dollar for dollar. Your credits reduce your tax liability, okay? And so when you think about credits, right, there's one credit out there for if you provide health insurance for your employees, right? Something that you should do, right? If you have employees that are full time, right? Something that you can do, I should say. And so there's a credit out there. However, there are certain rules that you have to meet, or certain stipulations in place in order for you to take advantage of these credits. Okay, so you want to make sure that you're abiding by all the stipulations. But if you do, 50% of what you're paying in premiums for your employees can be written off, right? It can be taken as a credit. How awesome is that? Right? So you get the benefit of feeling good knowing that, hey, I'm a small business owner that can offer health insurance to my employee, and I can take advantage of this credit at the end of the year for doing that, right? It's a win-win. It makes you feel warm and fuzzy inside, and you get to get some of that money back, right? A work opportunity credit. This is a big one, all right? So you actually can get a credit up to $2,400 per employee, depending on who you hire. Okay, so we're talking about veterans. We're talking about ex-felons. We're talking about people that receive assistance from the government, right? Low income people. And so you actually can get a credit for hiring those persons. Again, you gotta make sure that you do it right from the start. So if you are thinking or considering of hiring someone that meets one of those stipulations, connect with the professional to make sure that you have all the documentation in place so that at the end of the year, you can take advantage of these credits, okay? So work opportunity credit is a good one. Research and development credit. Who knew that they're going to give you money for you to do your own research and development? Wow, right? So, and when I'm talking about research and development, a lot of people tend to think about, like, you think about the pharmaceutical companies, or you think about, I don't know, like the Googles and people that are research and development and technologies, or things of that nature. But you can also leverage this credit for research and development and just increasing, or I should say, making your business more efficient, okay? Business efficiency improvements, quality control improvements, even new business processes, okay, all can lend to this research and development credit, right? So again, connect with the professional to make sure that you have all the T's crossed, all the I's dotted, right? In order to take advantage of this credit at the end of the year, okay? And then we have our alternative motor vehicle credit, or our electric car credit. Now, let me tell you, this is funny. I've had clients that come to me and say, trying to get that new Tesla. What can I get? Like, somebody told me I could write off my whole car. I was like, no, not the whole car. But you can, definitely write off a portion of it, right? I explained that earlier when we talked about leveraging your assets, right? And using that bonus rule. And then you can also get a credit, right, for your electric vehicle. And I think it caps you at $7,500. So just know, like, the Tesla that I want, right, is like a $96,000 car. So if I'm buying that just for tax strategy, for tax advantages, like, I don't think it's not as advantageous. But if I'm buying it because I really like it and I can use it for business purposes and take advantage of the different tax strategies that I said, then it's definitely a win-win-win, right? But just be mindful of that. So don't listen when people say, oh, you can write off the whole thing. Honey, no. You're not going to be able to write off the whole thing, at least not within the first year. But you do have the ability of depreciating it. And we talked about that bonus rule that you can put in place for that. So that's a good one. And then finally, the final credit, but not the last credit. Y'all, there's many other credits, but this is where I'm stopping. The last credit that I'm going to mention is setting up a pension plan, right, for your employees. So you do get a credit for setting up a small business pension plan. And we talked about some of those retirement plans up front. So definitely connect with an expert, right? A financial advisor. Make sure that you have everything set up properly so you can take advantage of these credits, because a lot of these credits have a lot of stipulations that have to be in place. I mean, they want it down to the letter in order for you to take advantage of it. So you have to connect with a professional early on to make sure that you are setting it up right. Okay. JP says, haha, that Tesla might become a pain. It may, JP, but you know what? I mean, I want what I want. Okay, Wayne says, don't forget the new Indian motorcycle when you get your Tesla. Okay, Wayne. Okay, see how he trying to get in on this. How we going to write that off as a business motor vehicle, Wayne? I don't know. So, anywho, I hope that you found all of this information helpful, right? Casey says, I need to start a business. Casey, I'm telling you, we can connect after the live. We can definitely talk. So I hope you found all of this information very, very helpful. It was definitely a lot of information. Samurai 990410 says, what is the best way? Oh, he's asking, what is the best way to stay current on changing tax laws, such as the ones that you're discussing? I subscribe to a lot of newsletters directly from the IRS. What I usually tell clients is you can definitely go to the IRS's website and you can type in what's new. And then it will give you kind of like a synopsis of all of the tax laws that are new. You may not get all of them. So like the best thing to do is definitely connect with someone like myself, who this is my job, right? This is my job to stay on top of all of the tax laws, because I want to make sure that I am maximizing every credit, every deduction for my clients, right? So this is my job. So I say, Wayne, like if you don't have the time to do it that way, just connect with me. I got you. All right. So again, hope that you found it helpful. One more last question. I'm sorry. How do you determine the difference between an asset and a liability if you are not sure? Oh, good question. So small business owners, assets and liabilities are what appear on your balance sheet statement. Okay. And so an asset is something that has value, right? Or can be converted into something valuable like cash. And a liability is a debt. It's a long-term debt. It's money that you owe. So assets make you money or can be converted into money, and a liability takes away your money, or it's a debt or something that you owe. So hopefully that made it simple for you. So that's the difference between an asset and a liability, right? And they both show up on your balance sheet statement. Angelica says, this is beyond valuable. Thank you for sharing your knowledge. You're so welcome, Angelica. I'm glad you were able to join the live. So again, thank you all for tuning in, Fye Finance family. If you love these tips and these strategies and you want to learn more, I would love to teach you more. So definitely visit the website, all right? Book a consultation. All my consultations are free. And we would definitely love to connect with you so that we can start implementing these strategies with you today for your business, right? I want us all to win, y'all. And I know that, good, bad, or indifferent, whatever you think about Trump, one day I'm not paying taxes either. So I'm just saying. So if you want to be on that same bandwagon, holler at your girl, right? Angela says, I'm hired. Thank you, baby. I got you. So again, thank you so much for tuning in to this episode of Samara says we're winning. Thank you so much for tuning in to this episode. Again, I hope it was helpful. But until next time, Fye Finance family, again, don't forget to connect, right? If you want to take advantage of these strategies. But until next time, you have a blessed and wonderful Tuesday evening. Bye.